Imagine you're at a store that sells tickets for a concert. Some people buy tickets in advance, like buying options, while others decide to buy them closer to the concert date. The store manager, or market makers, needs to make sure there are enough tickets for everyone who wants to buy. Here's how a gamma squeeze happens. Many people start buying a specific type of ticket, call options, for the concert. As more people buy these call options, the store manager worries that they might run out of tickets, so they start buying more concert tickets themselves to ensure they can meet the demand. Because the store manager is buying more tickets, the price of concert tickets starts to go up. As the price goes up, more people get excited and buy more call options, causing the store manager to buy even more tickets to cover the new demand. This cycle of buying more and more tickets pushes the price up rapidly, causing a squeeze. In the stock market, a gamma squeeze can cause the price of a stock to rise quickly because the market makers, like the store manager, need to keep buying the stock to cover the options they've sold. Explanation for a seasoned options trader. Gamma squeeze in options trading. A gamma squeeze occurs when there's a significant and rapid increase in the price of a stock due to the hedging activities of market makers. Here's a more detailed breakdown. High open interest in call options. A substantial open interest in out-of-the-money call options can set the stage for a gamma squeeze as the underlying stock price approaches the strike price of these out-of-the-money options. Market makers who sold these options are exposed to increasing risk. Delta hedging. To mitigate this risk, market makers engage in delta hedging. As the stock price rises, the delta, which is the sensitivity of the option's price to the underlying stock price of these call options, increases. Market makers must buy the underlying stock to hedge their short call positions, leading to upward pressure on the stock price. Gamma impact. Gamma measures the rate of change of delta. As the stock price moves closer to the strike price, the gamma increases, causing deltas to change more rapidly. This requires market makers to buy even more of the underlying stock at an accelerating rate, amplifying the price movement. Feedback loop. This continuous hedging activity can create a feedback loop where the rising stock price forces more delta hedging, which further drives up the stock price. The effect can be especially pronounced if the initial move is driven by a catalyst, such as positive news or strong buying interest from retail or institutional investors. Exacerbation by volatility. High implied volatility can exacerbate the gamma squeeze. Elevated volatility increases the gamma of out-of-the-money options, leading to more aggressive delta hedging by market makers. Resolution. A gamma squeeze often resolves when the buying pressure subsides, the options expire, or new information changes the market sentiment. However, during the squeeze, the stock can experience significant and rapid price increases. In summary, a gamma squeeze is a phenomenon where the hedging activities of market makers, driven by increasing gamma and delta of options, create a self-reinforcing cycle of stock price appreciation. Assessing the likelihood of a gamma squeeze. You can assess the likelihood of a gamma squeeze by analyzing certain data points and market conditions. Here are some key indicators to look for. 1. Open interest in volume. High open interest in call options. Look for unusually high open interest in call options above the current share price. This indicates that many traders are betting on the stock's price going up. Increased trading volume in options. A significant increase in the trading volume of call options can signal that many market participants are taking bullish positions. 2. Implied volatility. Rising implied volatility. High and rising implied volatility can indicate increased expectations of future price movements. Elevated implied volatility in out-of-the-money call options can amplify the potential for a gamma squeeze. 3. Delta and gamma metrics. Delta changes. Monitor the delta of out-of-the-money call options. As the stock price moves closer to the strike price, the delta will increase, indicating a higher likelihood of hedging activity by market makers. Gamma concentration. High gamma levels particularly in out-of-the-money call options, suggest that small changes in the stock price could lead to significant changes in delta, necessitating aggressive hedging by market makers. 4. Stock price movements approaching key strike prices. If the stock price is moving towards a strike price with high open interest, it increases the likelihood of a gamma squeeze as market makers will need to hedge their positions. Rapid price movements. Sudden and sharp increases in the stock price can trigger more delta hedging by market makers, contributing to a potential squeeze. 5. Market sentiment and news. Positive news catalysts. Announcements such as earnings beats, product launches, or other positive news can drive stock price increases, initiating a gamma squeeze. Retail and institutional activity. Significant buying activity from retail or institutional investors can also drive the stock price up, contributing to a gamma squeeze. 6. Short interest. High short interest. While not directly related to gamma, high short interest can interact with a gamma squeeze, as short sellers may be forced to cover their positions, adding to the buying pressure. How to use this data. Identify high open interest strikes. Check the options chain for strikes with high open interest, particularly out-of-the-money call options. Monitor implied volatility trends. Use tools like the implied volatility rank to see how current implied volatility compares to historical levels. Analyze delta and gamma. Use options analytics tools to monitor changes in delta and gamma for the relevant options. Track stock price movements. Keep an eye on the stock's price movements, especially if it's approaching significant strike prices. Follow market news. Stay informed about news and developments that could impact the stock's price. By combining these indicators, you can better assess the potential for a gamma squeeze. However, predicting a gamma squeeze with certainty is challenging, as it depends on dynamic market conditions and the actions of various market participants.